real quickly, way too quickly, as I said to someone this morning. I wish this was May. I would like to go through that whole thing again. Oh, well. Let's deal with what we've got. Great programming as always here at TFNN for 3 hours. I hope I can give you another hour of that. And you've got programming all day. Got Nico and Paige coming after me. And you've got, let's see, you got probably a repeat. Then you got Dave White. You've got Tom O'Brien. I mean, what more could you want? Well, let's look at the market. The Dow's down 44 at 16,609. S&P's down 90 at 1985, only down 1.75 points. You've got the comp index up 1 at 48.14. The Qs, now this is going to be very interesting because the QQQ series is just down a fraction at 19 at 105.45. And in fact, there were a number of stocks that were in the QQQs that made a big difference to it having a really good rally, a robust rally all week. And we're going to be watching that very closely. The volatility index is, at this point, it's still up there. It's at 26. It should already be in the 20. It should actually be under 20. So this is very interesting that fund managers are still continuing to buy some kind of protection. Then we're not out of the woods yet. So let me just show you here. I've got the chart of the E-minis. Wonderful move from 1831, round number low on Monday. You've had a move to 1992. That's 160 points. That is really big in 1 week. And, of course, not as big as the down move that occurred the week before. But still, I mean, as a spontaneous combustion to the upside, look at this candle in the weekly. That candle is, in fact, about it's probably even bigger. Actually, it's worth doing. So you've got 160-ish points. So let's go 160 from the low that was made. Well, no, 160 above. Oh, boy. 1992, so that's 21, should have done that quicker, 2150, and the high was 2126. Actually, you know what, this is really even easier to do. Let's just do this and I'll show you something very interesting. See that candle right there? I'll repeat that candle, new parallel, and we'll put it above, and you'll see that we go just slightly higher right there. Yep, 2150s. So we've come back even more than we went down, and we took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 weeks to come down, and 1 week to come back that same amount. Not to the top, I'm saying to come back from the low that was made in 1831. That is impressive. Now, I wanted to just go through the little routine, which I just thought of as I was looking at the chart, because I'm very visual and charts give me the information that I need. But more importantly, look, this is the 120-minute chart. And so far from yesterday, remember there was that sudden sell-off, and then look at that sell-off down to 1944, and then whoop, all the way back. And now what we're looking at is that 1992.75 high has only given back to the 1967s this morning. And it's made this rectangle formation, and it's making a little cup formation. And the reason why I wanted to spend a little time on this, and why I wanted to say that in my opening call, my subscription service for those tigers that are interested in a very comprehensive look at the markets, what we're looking at intraday, how you can use techniques that I've developed. Yesterday, the Chapman wave trend gauge gave a reading that suggested that today, they would, regardless of how strong we close, there could be a down move, negative move in the Dow. Got that. These are the indicators that I've built up, not over years, but decades, and I impart them all. In fact, out of all the techniques that I've discussed, there's only one technique that I haven't given out, and I'm not giving it out because it's something that if I give the numbers out, those numbers are liable to change over a period of time, and people will get stuck thinking it's one particular number. But let's just say that if the trend closes intraday, if it spikes high, or very low, there's a good chance that those indicators that I've worked on could, in fact, kick in. Now, let me tell you why I'm spending time on this on this little preamble. Let me just run the numbers, continue. The gold is up 13 at 11.35. Silver's up 0.06 at 14.50. We got out of our gold trade the other day for a little profit. I just wasn't interested. I think there are other things going on that are way more important. Crude oil is up at 194 at 44.50. High-grade copper is having a really nice move. We've taken advantage of that, as you know. I discussed it with Tom yesterday. High-grade copper is actually very strong. Nice turnaround. This candle is going to be such an important candle based on next week's action that we will look back and say, hey, that was really quite a move in copper. Now look what it's telling us, and we'll see what it's telling us. So nice move in copper. You've got bonds up 4/32 at 157. TLT is up 70 at 122.71. I'll go through these in a moment. What I wanted to get to right now, the dollar's a little bit. I need to talk about the dollar. Yep, the dollars. You see, this is very interesting. Counter trend move right now, I think, in gold. At least I have to consider that. And a nice move up in the dollar. Let's see, I've got it up at 95.90, up 25 cents, 95.94 actually. So I'm a little behind, and maybe just a few cents different. But it's holding that 9-period moving average, and the MACD and stochastic are good. The weekly chart, the stochastic and all that suggests there's going to be a lot of resistance in the low 96s. But if the dollar closes above 96, I was thinking 96.30. Now I'm going to go a little higher, 96.50 over the next few days. That's going to be very impressive action. That monthly chart is still very impressive. I'm only talking about the technicals here in the dollar weekly chart. The price itself is acting very well. So I need to do this right away because I do not want to run out of time. So I've gone through those numbers. That's important. What I wanted to show is this. For subscribers, I had shown that yellow circled cluster pattern that we were experiencing this week, where the Dow slumped down to 15,370, below the 15,855 low that we were looking at from October, quite decisively, actually. So on the 27th of August, it closes with a doji candle. No, sorry, it closes with what I call, I should have typed that in. I just completely forgot. This is called Chapman Wave Roman. Why do I call it a Chapman Wave Roman candle? Because it's a technique that I developed, and I've never ever read or anything about it, other than it's what I experienced, and I'm, as I say, very visual. And I came to the conclusion after seeing the results of this particular candle for so many years, that I just decided that that was a technique I was going to use. Remember, I tried these things out in real time for a long time. It cost me a lot of money to get these right. So Chapman Wave Roman candle. If it's at a low of a particular down move, it becomes very positive if within a very quick time there are closes above the high bar. In this case, the high bar would be, whoops, I didn't mean to do that. The high bar would be 16,459.75. Okay. Now, what we're looking at here is when it occurs. Let me just jump quickly to a monthly chart just for a second, because if I'm talking about something, I want to give you as much information as I can. There you are. That's a Roman candle, but very close to the all-time highs. Let me just take this back a bit, right? Very close to all-time highs. That suggests a completely different scenario. It says that if at any point, this is a monthly candle, if at any point there is a move down, and intra-week, this is not even, I'm skipping a whole stage. I'm not talking about the weekly chart. I'm saying intra-week. If on a daily basis there are a few closes in this particular case, that midpoint right there at 16,057, I'm going to call it under 16,000. There's just a really good chance that you've made a confirmation that this candle is telling you that you're going to not only go to the low, that's that 15,370 level, but you're going to take it out. And it's going to confirm a deeper down move. So now, the reason why I want to spend a little time talking about the moment that we're at right now, and I know that I had a couple of questions. Would I do another webinar? Because I'm expecting 4 down in Elliott wave in the market, And what should people do if they're looking at bigger pictures? They don't want to do these short-term trades. We've had some fantastic moves to the upside over the last couple of days in my opening call in certain stocks. I'll see if I can put something together. But yes, I think that it'll be a little shorter than the time period I wanted for the fourth webinar. But time is of the essence now. And let me explain why. I'm going back to this. See the cluster pattern? Sharp move down, Roman candle. We've closed once above the high that I was just talking about. And now we're going to go to the second day. I'm going to make this, I'm going to expand it for the moment just so that you can see it a little clearer. Look, right there. Look at that beautiful pattern. Look at those strong candles. Strong candle on Wednesday, strong candle on Thursday. Today's decline is a buying opportunity, people think, because they didn't even let it go down more than to Dow 16,552. I was thinking maybe 16,470s, maybe even 16,450s would be hit. And so far today, we've only gone down to 16,552. And now the Dow's only down 35 points. Now, the reason why I'm making a big deal about this is, look, you see these circles? You see a big candle and it fails, but you see the technicals are really very poor. In this one here, you've got a big candle, then a very sharp down day. Then you had another candle and it started to mix it up, up, down, up, down, up, down, the sandwich effect. I used to discuss that and it became a pattern we were looking at. But wait a minute, coming off major lows like October, you had the doji, the Roman Chapman wave Roman candle. There it is. I wrote it in. Chapman wave Roman candle, but at potential low. I typed in. Then you remember I was in Australia at the time. The next day, after that, I had to flip from the short side. We tried to go to the long side. I think the same thing happened as we just experienced now. We either just missed getting in or we got in and I kept the stops a little too tight. So we missed out and then we got in later on. But in the meantime, the second day, the first day after the low bar was made, doji type candle inside bar. Second day breaks out. Third day, a little bit of a doji candle. Fourth day breaks out, consolidation, and then it goes on its way up. So that was a major upthrust. Why am I making a big deal about it? Because if you look at many charts, this is the same thing here, but with a little bit smaller candles, the same process. And this was back in August of 2014. But you can go back and you will see that these moves off the low that have the big candles are really important. So Basil Chapman, Tiger Technicians Hour. Now we can go on with our analysis and I'll discuss what the implications are. Dow down 35, S&P unch.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming, see high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Basil takes your phone calls. Now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks, we're back. So what I discussed, well, not discussed because I was the only one talking, what I mentioned to subscribers yesterday and today is that perhaps what I'm looking at in the commodity area is going to allow some kind of support to come into the market because of the mix that you have. For instance, in the Dow, you've got Chevron and you've got Exxon, XOM, fabulous V-shaped bottom. I was actually going to go long for subscribers if we got other things instead. This is a very nice move in XOM right now, trading at it's 75.43, up 58 cents, coming off the 66.55 low of just 5 sessions ago. Now, I've done this in my own way. Remember, this is not pure Elliott wave. This is my interpretation. And I said that although we're not getting, I don't think we're going to get a climactic low. I think that this has all the characteristics, and I'm in a little disagreement with some of the experts, but this is the way I've got it, that I'm thinking that this is a 5 down in the weekly. In the Elliott wave, in the Chapman wave, it's that extended move to the D side. And that says D. I'm sorry. This is actually, I meant to change that. This is A, B, C, D. Yeah. In the weekly chart, there's a second move down. So this is to a leg D, trough D on the downside. As the stochastic and MACD look like they're ready to turn with a huge volume spike. Now, I don't know what the volume is going to be like at the end of the day, but if there's a volume spike, it's going to be the same analysis that I did in one of the stocks, FCX, for instance, which had a spectacular move from the 776 level to actually last night it went to 1260. Now the high today is 1148. It's pulling back sharply. It's down. It's up 40 cents. It's at 1057. But the spike is really what I was looking, which I had circled. And as far as I can tell, this candle, the close of this candle and next week's close is going to be very important. So if we're looking at copper rallying, we're looking at oil, USO. I had a question about USO. Yeah, USO leg B. I think this is going to be one of the most important candles that these commodities have had for a long time this week. But the theory I have is that this has to be treated as a bounce. Could be very sharp percentage-wise, but a bounce nevertheless based on the monthly charts, number one. And number two, the implication is if I'm getting, and I only do this on daily charts, it's called the Chapman wave, low bar volume spike. That explains the whole thing. It's where there's a climactic low, and the world is, everybody throws out the bathwater with the baby, etc., and that creates a low of consequence. But it is a low that is, the volume cannot be the day before. The volume cannot be the day after. It might work, but my technique says it's the volume of that day. And we've had it for a long time. Remember, there was a year or so ago, I had that volume spike, and I said that the XAU should bounce before 28 days. Maybe it can go a little longer, and actually went for longer than that, but it had that bounce, and then it retested the low. And this is the same thing. Now, I use it for daily. I don't believe I can make this for a half a year, 28 weeks. So when you say, no, it is a very important. A close above the candle high this week in USO, which is the United States Oil Fund, that was the question, it would say to me, a close above 1475 or whatever the high is today. If you can close, if the USO can close next week above 1510, let's call it 1510. Then all of a sudden the 1559 9-period exponential moving average becomes a magnet, and it should become a propellant. And that's how you could go higher. Then you could have a rally of quite a few weeks, and it could even go to the 9-period moving average of the monthly at 1964. We're talking about 5%. We're talking about 33% gain. Okay. Now, the reason why I'm putting this together is if you finally have Exxon and Chevron, CVX, same sort of thing. Also in wave 5, there's my interpretation of the Elliott wave, 5 down, but I don't think it's a climactic one, because I think this is going to become a complex wave, and that it's going to go lower later on. But that 200-period moving average has just been hit, and you're getting a Roman candle in the monthly chart right here. So a close next week in Chevron, which is at 80.14, CVX up 250. If there is a close next week anywhere above 8250 to 8310, it says that you could touch that 9-period moving average of 8673. That'll help improve the weekly chart. So I'm going through this, and I'm saying you got enough integrated oils and other oils, etc., and commodities in the S&P and it's all across the board. That could help stabilize this market. That's the reason I'm going back to this chart over here. That's the reason why. There it is. I'll look at this again. I want you to see it clearly. This rally might have legs. I'll be right back.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Technomental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up up today and try this amazing piece of software by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, we're back. So the Dow now is up 7, S&P is up 5, and one of the reasons why we wanted to add to longs is because of that chart pattern. And I was asked if I would just talk about it a little bit more today. And let me just show you a couple of things here. Look at bonds. Bonds rallied to. Wait a minute. Why do I have bonds down $1 something? Oh, it's a little late then. Okay. I have bonds at 155 and 10/30 seconds, down $1 and 20/30 seconds. Hit the 9-period moving average and is pulling back. One of the things that I'm looking at here is in the context of where we are market-wise, and in the context of looking at the, how can I put it? Looking at the aspect of money sometimes flowing out of bonds into equities and sometimes flowing out of equities into bonds. That scale, that weighing of the seesaw battle there. I still believe that there's a chance that the Fed holds tight. But most importantly, what I think I'm looking at here is that the Japanization of our bond funds, U.S. bond funds that is, let me just go to this chart here, right there, is going to get its biggest test. If instead of moving to the 162s over the coming month, they break this low of 145 and 27/30 seconds in the continuous contract. In other words, this trend line, which it's been to before many times and then broken out to the upside. Is this the change? Is this the moment of truth? So most importantly, what we're looking at here is the Japanization of bond yields, implying that the Fed is forced to keep rates low, I think should continue, but it's a break of these major parameters. And in a moment, if I have a chance, I'll go to my weekly charts. But in the meantime, I just want you to go back to what I was looking at before right here. This is a clear chart. You see this move, and that every time, this is the move now, this is the move off the October low. Every time there was a pullback, it was one bar. You remember, I have this, for those of you who have taken my Master Trader series, you know I talk about 136. A bull phase has no more than a 1, maximum of 3 bars of a pullback, and then it's at a recovery high. That's the best move. Yes, it can go in this very choppy stair-step way, but the most powerful move comes from very brief hiatus, a little like you're just a fuel pump. You're just stopping for a little gas, and whoop, you're on your way. Look, there's another one. Here's another one. Just a brief moment. Then there's this one that took 1, 2, 3, 4, 5, 6 day. There's the 6th day. It breaks out. The 6th day implies a much choppier move. It also implies you got to be careful because you could get a reversal down. Number one. Number two is that the question that I should be asked, and I certainly am asking, there's another one, from February, the 5th of February last year. Look at that beautiful move. How much did it take? 1 bar rest, blap. 1, 2 bar rest, blop. 1, 2, 3 bars rest, bam. And that's the best of a bull market. In a down phase, it could be the same thing to the downside, but more importantly, in a down phase, you could also get the fear of a crash, and it creates these big black bars that you're looking at here. I've got the white bars going up, black bars going down. So this is a very important period. Why? Because so far we've matched that takeoff. I mean, to me, that I cannot ignore it. So it's saying to me that is there a chance that it can go from a buy signal to a buy mode in the daily? Yes. Is there a chance that it can go from a buy signal to even a buy mode? We haven't even got the buy signal fully in place in the weekly chart, but from a buy signal to a buy mode in the weekly, which means now you're really looking at probably testing the old highs. I don't think that this is the time. I think we still have to keep the consolidation going. That is, that move to the downside. So I'll draw in a pattern here, and we'll revisit it sometime. You have a pattern right there. And that says, yeah, the Dow could, in fact, if this is one of those moves, in fact, it could even go a little higher. You could get back that horrible last week decline and go all the way to that little doji candle at 17,568. 17,568, that's 900 points up from here. I don't even want to, all I'm saying is the reason why we've been wanting to buy the long side of the Dow is because I just want to be there. If it unfolds like that, by the signal we had on the 6th of March 2009 when we went long, but there I had a much wider stop because I thought this one has to work right away. And then it turned out we didn't do the retest, and all we had to do was keep our position. I mean, that's the best way to do it. You let the market say, hey, I'm in position. Now you can either go up a lot or you can stall. I don't care. I'm in position and I'm going to make money. I'll make less money or more money, depending on what you're going to turn out to do. But I need to look at the stochastic of MACD. So the close today is going to be very important. I'll do that for my subscribers over the weekend. On Saturday, I'll start sending out charts with my analysis. So the thing is, the tough thing right now is, what do I do with subscribers who are really investors in the longer term? So in looking at the picture on what to do, that for me is the real big issue. I know what to do in the short term. We just follow the charts and buy signals, etc., sell signals. But what do you do? Do you get out now? And you get out, I've already said, take some money off the table. I've been saying that for months. Take something off. There are going to be some beautiful buys. Maybe some of them are coming in. I haven't recognized it. Maybe the Exxon one was, in fact, a beautiful buy. I don't know. But I know that we are trying to do that. We're trying to buy lows in stocks that have patterns that say they might be market independent and they could, in fact, rally. So this is the issue. I'm going to wait a little bit longer, but I will be making suggestions on what I think should be done for subscribers who have IRA portfolios, independent portfolios, that it's important. They do not want to take another 15% to the downside or more. But they also don't want to get out early if the market is going to go to new highs. They're even prepared. If the market is only going to go down a little bit lower than it was just recently, they're even prepared to hold on, because what's their point? You get out now and then all of a sudden you get back when there's a big move up. and it's 3%, and it's cost you in and out, and you got all this other stuff that goes on. So some people are prepared to wait. If there's going to be a pullback, that is going to be not as deep as many people are saying, down in the 13,000s or 14,000s. But if it's just down the test the 15,000 level again, or maybe just go under it, they're prepared to wait, because if I'm thinking that there's going to be a move to the 19,000s, then it's very important that in your long-term perspective, you don't get shaken out. You could even add. So I didn't see that. I'm sorry. I do have a caller, I believe. Let me go to that. Caller, how are you?
Scott in Safety Harbor, you are the longest-winded person in America, but not in Britain.
Thank you. Okay, well, as long as we use that wind to power the sails, that's good.
There you go. I'm looking at Apple, and I'm getting mixed messages from you. Are you seeing an up market next week or a down market? Because I can't figure it out right now, and that's unusual.
As it stands right now, I just explained that if we have only a one-day decline, and next week we make new recovery highs, that's going to be very important for me, and that's continuing the pattern of the up move. So, and I'm anticipating that next week, somehow or other, and I think it might go into Monday, this consolidation. If by
so you're
Tuesday,
looking at a down day Monday then?
I believe that.
Because that's where I'm at. I'm looking at a down day Monday, then the guys will do the same thing as usual, it'll be a little bit down, and they're like, geez, because they're looking for, believe it or not, and you know this, there's a ton of people that have still missed the whole thing.
Yes. Now, okay, so listen, this is what I'm going to say. Try to think separately. And I know that you try to do that with your stocks. I'm going to say, for instance, I've had my TV off in my office for a long time. Maybe for me a long time, maybe 2 weeks, maybe 3 weeks. I've done this periodically before, and I find
you did
that I just find that no, it's actually it turns out yes, but it's not that. I find that there's enough going on in my. I've got all these screens and all this stuff and computers and stuff. There's enough going on. I do not need another distraction. And now what I'm going to say to you is, look, Apple is down only 23 cents. At 112.68. If you look at the weekly candle, it is a magnificent candle, but it's unfortunately towards the lower end, and the tip of the candle of this week took out very important support at 95.18. Fact is, it's come back very strongly. So I'm going to try for you to separate the markets. I'm going to say to you, Scott, Apple at this particular point is acting very well. The 120-minute chart has gone to a peak C at 113.24, and then it went to a peak D at 113.27. But the stochastics at 95%, 94%, and the MACD is still strong. So it's got 111.23 support. If it couldn't go down on a day like this, I suspect it's like a cork in water. It's waiting to pop to the upside again. And even though this is leg D, you've got to be a little bit careful in Ds. The fact that the stochastic is so strong, the fact that it is really the day's young, but it's at this point ignoring the market weakness. I think that Apple is wanting to bounce, and if it's able next week by Tuesday, let's say, if it's able to take out 114.60, and maybe close above that, there's a good chance next week he's going to try to have one more pop, and that pop will go to 116, 118.
Is a lot of the institutions, I think, that really spooked people at 92 low a few days ago.
Right.
It was like, whoa. I mean, they got a dose of reality. You and I realize that can happen, but a lot of people,
Correct.
even the pros, they really thought Apple was some sort of Leviathan, some piece of granite out there.
Right, now there's something else. Tom had spoken about this. There was a trade in the QQQs, and it went all the way down on Monday to the 84.74 level. That was a huge move down. But if you look at the chart of Apple, which in the daily chart is in leg B, could be no, it can't be a peak B because we just made a higher Yep, we made a higher high. So it's in leg B at this particular point. I believe that fund managers are trying to go as quickly as possible to the stocks that are acting best. So that's the way I'm looking at it. So I think that I would try to be independent, market independent. Look at Apple. I think it's still acting strong. It has a support between 111.20 and 110.90. And if it can take out by Monday or Tuesday that 113.70s to 114.20, somewhere around there, that's going to be very good action. So I hope you have a great weekend. Thanks for calling.
Thank you, Basil. Bye-bye.
Thank you very much. Let's go to Mark in Fort Collins. Hi, Mark. How are you?
Hey, Basil. How are you?
I'm well, thank you.
Good. Hey, I'm just looking at one rule. I did a quick. I went short a few things just in the last 15, 20 minutes based on. It looks like a lot of different charts are making a peak D in the 120-minute chart.
In the shorter term, yes.
Right, and so I'm thinking that I'm going to take this short maybe either through the end of the day or through Monday, and then look like maybe for another bounce. It sounds like that's kind of what you're thinking too.
Yeah. So if you are doing that, just be aware that you got that sense this morning. I'm sure if you were short from yesterday, then you'd be wondering, whoa, what happened late yesterday? And what happened this morning after that sharp sell-off and the quick rebound? But if you're looking at it, I'm still going to say almost the same as I said to Scott. Look, the 95% in the 120-minute chart, the MACD is still expanding, still the histogram is still expanding. It better be a real quick short, and if it's going to work, by the end of the day, the market suddenly gives up the gains that it was trying to give. The S&P closes down 6.5 to 7.5 points. The Dow closes down 75 to 85 points, and then you're going to get that follow-through on Monday. But I'm trying my very best. One of the reasons why I've got the TV off is I'm trying my very best to look at the market and try to discern the information that I'm gleaning from the stock patterns themselves, and the fact that I have enough indicators that say the move that we had from the bottom, and if you look at the chart right now that I'm showing of the QQQ, it hit the 200-period moving average. I mean, it wasn't even in sight because the next level of support was 99.36. It just skipped that. It just jumped and leaped and didn't even have a parachute on until it finally opened when it hit that trampoline of 85.36. So my thinking here is that it's a short-term play. I'm not sure how much you get out of it, but in that 136 methodology I have, you got to be real careful. So 104.32 is what you want to see taken out to get a nice profit in the 120-minute QQQ.
Okay, thanks.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. The Art of Timing the Trade charts has officially launched at TFNN. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind software, The Art of Timing the Trade charts allows you to scan for Fibonacci formation setups, including Gartley's, butterflies, ABCs, and much more. The Art of Timing the Trade charts is designed to help you when scouring the market for stocks just beginning to form the trading patterns that many investors spend days, weeks, and even months searching to find. As part of our introductory pricing, we're offering licenses available at only $59 per month. We're so confident that you'll love this new outstanding piece of charting software that we'll even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Lock in your low price today by ordering your copy at TFNN.com.
Learn about good health and fitness. Living a primal lifestyle with Nico and Paige. Next on TFNN.
Everyone, let's go to Greg in California. We're going to look at... Hi, Greg.
Good morning.
How are you?
Morning. I'm well, thanks. How are you?
I'm well, thank you. You'd like to look at?
USO.
Okay. Do you have a position in USO?
I do. I sold half the position just a little bit ago, and I was looking to re-entry or that back in for a little bit longer.
Okay. So you have a core position right now. Good. The reason why I asked you the question rather than just doing the analysis is there are two different things. If you're in it already, it's a lot easier to trade because you've got your core position. The big thing is going to be what happens with the single leg A, even though it's actually a B, in the USO. In crude oil, I believe it is still leg A to the upside. Now we know that, at least if anyone who knows my work knows that I often talk about the single leg A up that has a huge spectacular spike to the upside, and then all of a sudden instead of going to B, C, and D, peaks B, C, and D, it just reverses out of the blue, and it reverses in such a way that it says I don't know if I'm going to hold 50 or 60% of the gain. And what happens in this case is that if USO was to pull back more underneath 1360, that would be a failure pattern. We'd have to wait for another entry point. So here's my thinking. I love the action. I love the action of the weekly so far, but I'm going to need next week to confirm that this candle is as important as it should be. But the 120-minute chart is in leg C to the upside in USO, the United States Oil Fund, trading at 1467, up 72 cents. Big move. One of the biggest moves yesterday and today that it's had in just ages and ages. But if this is the case, it should get close to the 1517, I'd say 1490 to 1570 would be my upside target. Then we're going to get that moment of truth. But the stochastics at 93%, the MACD is expanding. So I think it's got a lot of support in the 1440 to the 1420 area. So what I'm going to say to you is, I love the action so far. You've done exactly the right thing because it's coming off a major low. We don't know if it's the low or if it's just a low. Therefore, you've got to use money management. You've done that. I'm going to suggest that you you hold your position, and if there can be a pullback, but it has to be very brief, to the 14.21 to 14, above $14. If there's a pullback and it suddenly finds support and it's holding, I would then add back a portion of the part that you just took off. Why? Because if it starts to move quickly and it moves back to 1440 or 1460, it's the right move. And if it pulls back underneath 1360, it says, don't hang around. So the stop should be fairly tight. But that's my recommendation. And let's see how it goes for a couple of days. So call me maybe Tuesday or Wednesday if you get a chance. Let's look at it together.
I will. Thank you.
And congratulations. Very nice trade.
Thank you. Great day.
Thank you. And you too.
Bye.
So, folks, let's just do this as we're about to wrap up. You're about to go to Nico and Paige. So this is what I want you to do. The VIX index is up 84 cents, but it's really just it's just barely above the 9-period moving average. So if by the end of the day the market pulls back even deeper, then we're going to be looking at what happens. Will the VIX pop above 29.90, yesterday's high? If it does that, it says Monday is probably going to be a weak session. Then we're going to have to see what happens the first of September. And the second, does money come back in? That's number one. Number two is if by the end of the day there's another rebound, and this rebound holds, the Dow's down now 80 and S&P is down 668. If in fact there's another rebound and there's a fairly narrow close and the volatility index pulls back underneath 2620, that's going to suggest very strongly that Monday buyers might come in. And I don't know whether it's Monday or Tuesday in that case that we try to tackle the high that we just made. So in fact, what I'm looking at is I'm still constructively positive. I'm expecting this rebound to go a little longer. At least that's my thinking. And we're going to have a lot of evidence at the close today and the trading for the first 2 days of next week. Thanks. Have a great weekend. Maybe you want to check out my opening call. Check it out over the weekend. Thanks for being here. Have a wonderful weekend.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN.